You open your chart, 50 candles in the last 10 minutes. Price up, price down, up again. You don't know if you're early, late, or just plain wrong. Here's the truth nobody tells beginners. You don't need 50 candles. You don't need 10 indicators. You don't need to watch the screen all day. You need one candle. One 4-hour candle, fully closed. That's it. That single close can tell you the direction the market actually wants to go, not what it's pretending to do in the next 60 seconds. In this video, I'm going to show you exactly how to read that one candle, how to use it to find your bias, your entry zone, your stop loss, and your target, step by step with real examples. No hype, no guaranteed profits. Just a simple way to stop guessing. Hey, welcome back. If you're new here, this channel is for people who are just starting out in trading and want to actually understand what they're doing, not just copy signals from a Telegram group and hope. Today we're talking about one specific tool, the 4-hour candle close. I want to be upfront with you. This is not a magic strategy that prints money every day. There is no such thing, and anyone who tells you otherwise is selling you something. What this is a simple, repeatable way to filter out the noise. It helps you decide, should I even be looking to buy or sell right now? And once you know that, your entries get cleaner, your stop losses make more sense, and you stop fighting the market. By the end of this video, you'll know exactly how to look at one H4 candle and pull 3 pieces of information out of it: the bias, the zone, and the trigger you're waiting for. Here's the problem almost every beginner runs into. You open your charts and you default to a small time frame, 1 minute, 5 minutes, maybe 15. Why? Because it feels exciting. Things are moving. You feel like you're doing something. But here's what's actually happening on that small time frame. You're watching noise, random little pushes up and down that don't mean anything on their own. A 5-minute candle going green doesn't tell you the market's direction. So what do beginners do? They react to every little wiggle. Price ticks up, they buy. Price ticks down, 2 minutes later they panic and close. Or worse, they flip and sell. By the end of the session, they've taken 8 trades, paid spread and commission 8 times, and they still don't know if the market was actually bullish or bearish that day. The fix isn't a secret indicator. The fix is zooming out. And the cleanest way to zoom out, without overcomplicating things, is the 4-hour chart. Let me describe a trade that probably sounds familiar. You're watching the 5-minute chart. Price breaks above a small high. You jump in, buy, feeling confident. 3 minutes later, price drops back below your entry. You're now in a losing position. Your heart rate goes up, and you start asking, do I cut it or do I hold and hope? This is the classic beginner mistake, trading a breakout on a small time frame with no idea what the bigger picture is doing. That breakout you saw on the 5-minute chart might be happening right in the middle of a 4-hour candle that's actually printing a strong rejection in the opposite direction. It's like trying to guess the weather for the whole day by looking out the window for 3 seconds. The fix is, never make your directional decision buy or sell based on a time frame that small. That decision belongs on a bigger, calmer time frame. That's where the 4-hour close comes in. So what exactly is an H4 candle close? Let's break it down simply. A 4-hour candle represents everything that happened in the market over a 4-hour window. It has an open, a close, a high, and a low. The most extreme prices reached during those 4 hours, shown as wicks. Because there are 24 hours in a day, you get exactly 6 of these candles per day. 6 decisions points instead of hundreds. Here's the part beginners miss. While that candle is still forming, the candle is not finished. It can still change shape completely. If you react to what the candle looks like in the middle of its formation, you're reacting to an unfinished sentence. The close is the moment that candle locks in. That's the moment we care about. Not the middle, not the wick poking out mid-candle. The close. A closed candle represents a finished battle between buyers and sellers over a real chunk of time. 4 full hours. It's not a guess. It's a result. You might be wondering, why 4 hours specifically? Why not 1 hour or daily? The 1 hour chart still has a lot of small noise, new spikes, session opens, random liquidity grabs that get fully reversed within hours. The daily chart is great for big picture context, but it's too slow for someone who actually wants to find entries during the week. By the time that daily candle closes, the move you wanted might already be over. The 4-hour chart sits right in the sweet spot. It's slow enough to filter out random noise, but fast enough that you get a fresh read 6 times a day. It also lines up nicely with how the real market actually moves. The Asian session, the London session, and the New York session each get represented by their own H4 candles. The H4 close gives you a cleaner, more reliable signal than chasing every flicker on a 1-minute chart. That's the whole point. Okay, so you're looking at one H4 candle that just closed. How do you actually read it for bias? Here are the 3 things you check in order. First, where did it close relative to its own range? If the candle closed near the top with a long body and a small upper wick, that's a strong, confident push. If it closed near the bottom with a long upper wick, that's rejection, not strength. Second, where did it close relative to a key level? If price closed above a meaningful resistance level with a strong body, not just barely poking above, that's a real signal. Buyers have taken control of that zone. Third, how does the body compare to recent candles? A candle with a noticeably bigger body than recent candles, an impulse. A candle tells you something changed. Momentum picked up. Put those 3 together. Strong close, in its range, closing beyond a key level, with a bigger than average body, and you have a clean directional close. That single candle is now giving you a bias. Let's make this concrete with an example. Imagine price has been stuck below a resistance level. Let's call it 1.085 on Euro USD. Several H4 candles have tried to push above it and failed, leaving long upper wicks each time. That tells you sellers have been defending that zone. Then, one H4 candle comes along, pushes through 1.085, and closes at 1.089, well above the level, with a strong body and only a tiny wick. Sellers tried to defend, and this time, they couldn't. Your bias just flipped to bullish. The level that used to block price from going up has just been broken with conviction. Old resistance, once broken cleanly, can flip into new support. Your plan becomes, I now have a bullish bias. I'm watching to see if price pulls back to the 1.085 zone. If it holds there instead of breaking back below it, that's my potential entry opportunity. Now let's flip it around with a bearish example, because the logic works exactly the same way in reverse. Say price has been holding above a support zone, 1.07. Buyers keep stepping in there, and every dip toward it gets bought back up, leaving long lower wicks on the H4 candles. Then one H4 candle pushes down through 1.07 and closes at 1.066, well below the level, with a strong red body and barely any wick underneath. That's a clean break. Buyers tried to defend and failed. Your bias now leans bearish. That old support, once broken with conviction, becomes a zone to watch for a potential retest from below. Again, this isn't sell the second it closes below. It's, I now have a bearish bias, and I'm watching for price to return to that broken zone and show rejection before I consider an entry. Reading the candle is only half the picture. The other half is knowing where on the chart to pay attention. Here are the 3 types of levels worth marking. 1. Previous day's high and low. A lot of price action tends to react around where the previous day topped out or bottomed out. Mark these every morning. 2. Clear swing highs and lows. Find the obvious turning points, a spot where price clearly reversed direction. If you have to convince yourself a level is significant, it probably isn't. The best levels just jump out at you. 3. Round numbers and session ranges. Levels like 1.1, 1.09, or the high, low of the Asian session box often act as decision points since a lot of orders cluster around them. Key principle: less is more. You want maybe 2 to 4 zones on your chart at any time, not 20. Mark a few zones, then wait patiently for an H4 candle to interact with one of them. Let's put everything together into one simple framework. The 5-step H4 close framework. Step 1. Mark your zones. Before the next H4 candle even closes, mark your 2 to 4 key levels. Do this in advance, not in the heat of the moment. Step 2. Wait for the H4 candle to fully close. This is the hardest step. Literally wait for the countdown timer to hit 0. Step 3. Read the close. 3 checks. Where did it close in its range? Did it close beyond one of your zones? Is the body bigger than recent candles? If yes to all, you have a bias. Step 4. Wait for the retest. Don't chase the breakout candle itself. Be patient and wait for price to pull back toward the broken zone. Step 5. Confirm your entry trigger. Drop to a 1-5-minute or 1-hour chart. Look for a rejection candle or small confirmation that the zone is holding. That's your green light. This framework forces you to wait twice for the close and for the retest. Patience is what filters out 90% of bad trades before they happen. Let's walk through a full, realistic bullish example. The H4 candle closes at 1.089, clearly above our marked resistance at 1.085, with a strong body and small wick. That's our clean bullish close. Bias, bullish. Over the next several hours, price pulls back to 1.0855, hovering just above our old resistance turned support zone around 1.085. This is the retest. We drop to the 1-5-minute chart. Price pokes to 1.0843, then snaps back above 1.085 with a small bullish body. Confirmation. Zone held. Entry. Buy around 1.0852. Stop loss. Around 1.083. 5 below the retest low. Target. Previous swing high at 1.096. Notice the whole trade is built on structure, not on a gut feeling. Every decision entry, stop, target ties back to something visible on the chart. Now the mirror version, bearish this time. Our H4 candle closes at 1.066, clearly below support at 1.07. Strong red body, tiny wick, bias, bearish. Price pulls back up over the next few hours toward 1.0695, just under that broken support, which is now acting as resistance. This is our retest. We drop to the 1-5-minute chart. Price pokes to 1.0708, then gets rejected and closes back below 1.07 with a small bearish body. Confirmation. Entry. Sell around 1.0698. Stop loss. Around 1.0715. Above the retest high. Target. Previous swing low at 1.058. Same logic, same structure, just flip direction. Bias from the close, patience for the retest, confirmation on a smaller time frame, then structure-based stop and target. That's the whole method. Your stop loss has a job: to get you out if the idea that got you in is actually wrong. It should sit at the point where, if price reaches it, your original read on the market is proven incorrect. In our framework, That point is usually just beyond the wick of the retest candle. If price goes back through that point, the zone you thought would hold didn't. A common beginner mistake is placing the stop loss too tight right at your entry or just a few pips away. Normal market noise will hit a tight stop almost every time, even on trades that would have worked. The opposite mistake is placing your stop loss way too far to avoid getting stopped out, which usually means you're oversized or not being honest about where your idea is invalidated. The fix: let the chart tell you where the stop goes. Beyond the recent wick, beyond the zone, beyond the point that proves you wrong. Just like your stop loss, your target shouldn't be a random number either. The simplest approach: target the next real structure level in the direction of your trade. If you're buying, that's the next visible swing high. If you're selling, it's the next visible swing low. These are realistic places where the market has already shown it's willing to pause or reverse. Once you have your entry, stop loss, and structure-based target, you can calculate your risk-to-reward ratio, how much you stand to gain compared to how much you're risking. In our bullish example, we risked about 17 pips to potentially gain around 70, roughly a 1-to-4 ratio. A beginner tip: you don't have to wait for the absolute final target. Many traders close part of their position at a closer level and let the rest run. That's a personal risk preference, not a rule. Before we wrap up, let's go through the mistakes that trip up almost everyone. Mistake 1: trading the wick, not the close. If you jump in while the candle is still forming, you're trading a guess. Wait for the close every time. Mistake 2: chasing the breakout candle itself. Entering right as the big H4 closes, without waiting for a retest, means you're buying at the most expensive point of the move. Mistake 3: ignoring the bigger picture. If the daily or weekly chart is screaming the opposite direction, an H4 bias against that bigger trend is riskier. H4 works best as one layer, not your only layer. Mistake 4: treating every H4 close as a trade signal. Not every close is clean. Not every close is at a meaningful zone. If the candle closes in the middle of nowhere with an average body, skip it. Mistake 5: moving your stop loss after entering. You already decided where your idea is invalidated. Trust the plan you made when you were calm. One last thing before the secret tip. This might be the most important part of the whole video. This method, like any method, will produce losing trades. That's not a flaw. That's just trading. The H4 close framework helps you find higher quality setups and avoid a lot of noise, but it doesn't make you right every single time. How much you risk on each trade matters just as much as how you find your entries. A common conservative approach: risk a small percentage of your account on any single trade, often around 1%. Sometimes less for beginners, so that even a string of losses doesn't end your ability to keep trading. This framework's job is to improve the quality of your decisions. Risk management's job is to make sure that even when a good decision still loses, because sometimes it will, you're still standing with your account and confidence intact. Alright, here's the tip. This is the one thing that took most experienced traders way too long to figure out, usually after a string of frustrating losses. The first retest is almost always the cleanest one. The more times price comes back to retest the same zone, the weaker that zone gets. The first time price returns to a broken zone, you're often dealing with fresh interest traders who missed the original move. That's usually where the cleanest, sharpest reaction happens. But if price tests that same zone a second time, and a third time, each visit chips away at it. The orders that were sitting there have already been filled. By the third or fourth retest, what used to be a strong wall is closer to a thin curtain. Practical version: when you see a clean H4 close at a fresh zone, prioritize the first pullback for your entry. If you miss it, and price comes back a second or third time, treat that setup with extra caution or let it go. There will always be another one. 6 new candles, every single day. Let's quickly recap what we covered today. One H4 candle close can give you a real, reliable bias, not by magic, but by reading three simple things: where it closed in its range, where it closed relative to a key zone, and how its body compares to recent candles. From there, mark your zones, wait for the close, wait for the retest, confirm entry on a smaller time frame with stop loss and target tied to real structure. And remember the tip: the first retest is usually your best shot. Don't force the second or third. This isn't about turning you into someone who never loses. It's about giving you a calmer, clearer way to make decisions, so your losses are smaller and more controlled, and your wins are built on something real. If this helped you see your charts differently, hit subscribe and drop a comment letting me know which pair you're going to practice this on first. See you in the next video.